Hi everyone and welcome to this week's edition of the Weekly Update with me, which is Paramarket Analyst at Take a Market. Each week I take you through the key events I believe will be driving your investments in the coming days. Now, moving into this week, we're still running off the legacy of several factors that played out at the end of last week. Starting with the airstrike that the US did over the Syrian airbase. That sort of drove a safe haven bid in the end of last week, and that sort of has took a bit of a break early Monday morning, but it seems to be coming back through the equity markets with a bit of a decline on equities as the European session has got through. There's still not really an indication yet of what sort of reaction we're going to get from Russia and potentially Iran with regards to the US going forward, so this still has something possibly to play out. We also have the non-farm payrolls report that was on Friday, with non-farm payrolls headline much worse than expected, but still the rest of the report was fairly solid and the market sort of regained its poise. The dollar started to strengthen again, US Treasury yields started to push higher, big reversal patterns on not only the dollar but also the Treasury yields as well, so very interesting moves that we've seen there. But the US Treasuries yield curve continues to flatten, and I've shown you here the 2 to 10 spread chart whereby that continues to contract. That suggests that the longer end of the yield curve is flattening off, and suggests that sort of the minutes in the Fed meeting still are playing out into the market, still having an impact, because what we saw last week is comments from Bill Dudley, FOMC member for, or FOMC president for New York. He suggested that perhaps the US was going to sort of, or the Fed was going to sort of take its foot slightly off the gas in terms of rate hikes going forward to accommodate the potential for the winding down of the balance sheet. Now that is interesting because it sort of changes the shift of monetary policy more towards a slightly more dovish move potentially, but obviously, I mean, selling down or winding down the balance sheet is ultimately a hawkish move, but if you're doing that at the same time as less monetary tightening in terms of interest rate hikes, then that has a potential to sort of impact on the dollar going forward. So interesting moves that we've seen there for the States, and the impact that we'll see, I think, going forward in the markets in the coming months. Now, into this week, we've got a lot of US data, and inflation is the key. It is the sort of last week or a shortened trading week before Easter, so it could be a bit of a quiet one on that regard, but still markets will be playing an interesting game, I think, in terms of sort of reacting to the safe havens and the non-farm payrolls report. So looking at the Forex markets, we've still got the euro, which is now starting to track lower again. It had that move on Friday whereby we saw a sharp move to the downside below 106. That's now sort of opening the 105 support area, the key February-March lows. Are we going to get a test of that? I'm not entirely sure whether it's going to break down, but I think we could get a test. In terms of cable, there is a slight outperformance still of cable, of sterling versus other forex majors other than the dollar, whereby the trade-weighted sterling is still sort of holding up pretty well, but still the dollar, it has been strengthening and is now pulling sterling lower. It's testing a key support at 123.45. Will that break to the downside? If it does, we're opening up 121 figure again. In terms of the dollar yen, there has been a bit of a rally. It's held onto an uptrend since September, but the 111.60 key pivot level is still the big level that remains in play. That still is a level that's finding resistance, and it still needs to break out above that to really sort of suggest that the dollar is gaining a bit of momentum again. In terms of your equity markets, we've seen a bit of a consolidation in recent days. That's sort of consolidating within what looks to be a bit of a corrective near-term move, though. You've got the S&P 500, say for example, in a 5-week downtrend. Is that going to sort of console to the downside and break to the downside? Possibly the support at 23.22 seems to be needs to hold to remain intact. The DAX is a little bit more positively configured. You've still got the breakout support at 12.82 to 12.156. That is still holding, but again, still not really convincing to the upside. FTSE 100 is a bit of a different kettle of fish. It's sort of threatening a bit of a top pattern. That's been going on for a while, but it's still holding up above the 72.55 level, which needs to hold to prevent what would look to be certainly a near-term corrective move that would reopen 7100. In terms of your commodity prices, you've still got an interesting move on gold. We saw the dollar being a big driver of markets on Friday afternoon, and that certainly impacted on gold. We saw gold breaking out initially above 1261. That then engaged in a false upside break and turned back lower, but unwound about almost $20 in the end. Still holding above 1250 near term, but sort of could test that 1240 key support if the dollar starts to strengthen again. The oil price is an interesting one because it's tracking high. It's got a strong uptrend now in the last couple of weeks, really is pushing on both WTI and Brent crude. The EIA oil inventories always play a key role in this chart, but certainly this compliance with the OPEC decision is helping to sort of support the oil price, and also some supply outages in Libya is only going to play into that positive play. But we're also looking at strong demand as well. With the summer coming up, we've got driving season in the States, and could we see the start of more gains on the oil price? So looking at the data this week, well, we've got starting off with UK inflation. It's expected to be around about the levels that we saw last month, 2.3% on the headline, 1.9% on the core. But you play into that with the average weekly earnings, which are expected to fall back to 2.1%. You're then starting to look at real wages going down for the first time in a while in the UK. China inflation is also on it was also on Tuesday, so that could play into the risk appetite attitude of traders on that day. And also, as the week sort of draws on, we're sort of looking at the US data, whereby we're looking out for CPI, which is not the Fed's preferred inflation data, but still interesting to see the CPI numbers, and also the retail sales, whereby retail sales are expected to continue to improve in the States. Again, that would help to drive the Fed's sort of expectation of economic improvement and tightening potentially coming further down the road. So lots of data this week still to trade on, despite the fact that it could well be a bit of a quiet one in terms of the markets, given the fact that it's a shortened trading week. But still, I wish you good luck in your trading, and I will speak to you next time. Thank you.